Hey folks, Dan Frio here with your market update for October 3rd, 2024. So rates went up a little bit yesterday. They're going to go up again today. We're monitoring basically a lot of things right now. We're monitoring the things that the Federal Reserve wants us to look at. So it's the jobs numbers, and then we can't throw everything else out the window because now we have the port strike, the wars continue, and everything else. So in today's video, we're going to take a deep dive into the jobs numbers that just came out today, and then we're going to look into the port closures and how devastating that can possibly be with all this stuff. So let's get over to it. Here's where mortgage rates are for today. They're going to tick up a little bit more, and the reason I know that is right through here. The MBS market is down 11. But let's get to the economic calendar we have for today. So here's the good news behind things. Okay, it's the jobs market. So if we dissect that, continued claims right through here. It was 1.827 million prior to that was the last reading, came in at 1.826, so pretty much dead on. Initial jobless claims 219,000, expected to tick up a little bit to 222. It went to 225, so nothing there. I'm not going to, that isn't a number that's like, whoa, that's way out of line. Then we get to the servicing numbers. And look at the rest of these numbers, 54, 54, 55, 55. Here's where here's the scary part, factory orders. Previously at 4.9, now it's 2. So if we monitor this, factory orders, and then the employment numbers, we're going to get a bead on where jobs are going to go from here, okay, especially the manufacturing jobs. Then we go down through other sections of this. This was at 50, it's 48. This was at 51, it came in at 54. This was at 57, 50, 59. So really what I want to do is dissect the pricing piece of this because we focus in on inflation. So if you go down here, you can say, okay, it came in at 59.4. The forecast was 56.3, previously 57.3. But what's the history behind this? Is this a big number, a small number? Well, let's go down and see what history tells us. So are we in line kind of? So we went from April at 53 to 59 to 56 to 56 to 57 to 57. So I'm going to say this is stagnant. Okay, I'll take a stagnant position in this area right through here. So that's basically the news we have out today, and nothing catastrophic. There's nothing here that's like, whoa, the continued claims, is spiking. It's staying steady, and then we didn't have initial jobless claims just blow out the roof. So that's one of the biggest concerns that we have. And then you go over to the markets. This is on Market Watch. It was just published today. The numbers. The number of Americans who applied for unemployment benefits last week rose slightly to a minuscule 225,000, affirming that layoffs remain surprisingly low, even though many companies have pulled the plug on hiring. So basically, we're not hiring, but we're not firing. So that section right through there. Let's get over to here. Now, here's what I've been trying to do is figure out, what is the port strike? How big or how devastating could that be to us? Okay, so there is a piece saying President Biden can jump in and rectify this thing. I might be on his side of the fence, just saying let them try to work it out so I don't come in and force my position on this. So let's check and see this part of the inflation front. There's an interview this morning because I'm even concerned with this. The biggest things right now is the port strikes. I'll say is maybe or probably bigger to the country's economy than the wars and everything else. But I could be, natural resources and things like that. Yes, that's the overseas part of this equation. But we've just kind of fixed these supply chains, and now we have this going on again. And a lot of people are saying also this is going to also really reduce our GDP and increase our inflation numbers. So let's get his take on it. Then when I come back, I'm going to show you an interview with our Secretary of, I think it was Transportation, Buttigieg, and what he's saying about will this get settled and how quick and so forth. So let's take a dive into this, and then all this is going to tie together from the rest of the equation. So let's get over to the interview.
A lot of economists are starting to say when you add it all up, the port strike, possible oil price increases from the Mideast, and so forth, the hurricane effect, that we could actually see a bit of a stagflationary Q4. What are your thoughts?
Yeah, thanks for having me. And that actually, when we see everything that's kind of on the horizon, Chair Powell probably has, almost like thrown his arms up in the air and maybe banged his head on his table, like, what do we do here? Because a lot of the data that we're going to be getting for the fourth quarter is going to be filled with all sorts of distortions. You've got the port strikes, as you mentioned, and so that's going to likely affect the employment numbers. We have to see how long the port strike lasts because they are.
And again, what we're focusing in on here is the whole equation that the Federal Reserve is monitoring. What's it going to do to inflation? What's it going to do to the jobs numbers? What's it going to do to our GDP? When will it get settled? These are all the things that we're really looking forward to, because we have to figure out where the economy is going from here if we're trying to figure out the equity markets and, especially where mortgage rates are going as well.
Going to have to worry about, does it extend past that October 12th as far as the survey date? So maybe it'll be resolved before then, but now you have higher oil prices. Those port strikes could lead to inflation. So you could see an environment in which you see that weakening labor market and higher temporary inflation. The Fed is going to ask themselves, are they going to just look through this and just stick to their plan? My guess is that Powell is probably really convinced that they do need to really get at least 2 more 25 basis point cuts in for this year. So perhaps they're a bit on autopilot despite all the noise that's going on.
Right, but autopilot meaning they continue to cut rates. The economy continues to expand. I mean, I'm interested to kind of look at how you're playing this market with industrials, healthcare, REITs, financials. Financials, by the way, one of the best names in the third quarter. Why so?
Yeah, I think that the reason is that we are seeing an economy that is slowing, but it's not necessarily stopping. There are, of course, risks out there that could lead to a recession or a more dramatic slowdown. But we think that the likelihood of those events are fairly low. And so if we go from really good growth to moderate growth and are able to kind of stay around here, we think that actually sets up a pretty good environment for like industrials from a valuation perspective. Looks pretty attractive. We know manufacturing.
Hold on, folks. Oh, he was just on. Let's look at this thing. If you guys follow me with my stock
like
trackings,
industrials from a valuation
right through
perspective.
here, he's the XLF. This is one of our picks. I don't know if you remember, but we created a portfolio within Yahoo, and I was saying a big analyst pick right now is the XLF, which is the financial spider. So he mentioned this in there. I just thought I would throw that in there because if you guys do follow me on the stock picking, we're going to go over our stock portfolios on Friday. Each Friday, we're going to basically see where we stand. But XLF was a piece of that because it is an economist's kind of dream portfolio right now in the financial sector. And he's going to give you some other ideas out there on where, what sectors are doing good and what sectors possibly to avoid.
Looks pretty attractive. We know manufacturing has effectively been in a recession for about, like 24 months now already. And so if they get a little bit more traction, healthcare also looks attractive. And then with financials, as the Fed continues to cut rates, that should be good for their funding costs and also take some pressure off of those parts of their loan book that are experiencing an increase in defaults. And so those are 3 of the areas that here at Annex on our investment committee that we're kind of optimistic about for the balance of this year.
Brian, you don't have to give like one side or the other answer to this question, but we do have this election coming up. Does it matter to the market how the election turns out? And I say that because watching the VP debate last night, which, by the way, was incredibly civil and it was hugs and it was kind and it gave you hope and whatever, it doesn't seem like the two sides' economic policies, not social, but economic policies are that much different. Maybe a little adjusting over here for tax, a little higher corporate tax rate over there. We also have Congress, which is probably going to be split. Nothing will probably get done no matter who wins. Anyway, does the market care about the outcome?
Yeah, I think that the market does care about the outcome because there is a scenario where, let's say if it's a Democrat sweep, where you could see a situation where they try to get rid of the filibuster and they actually are able to get this almost wish list of policies through, which do include an increase in corporate tax rates, the top marginal tax rate. Really for the markets, the bigger companies, they don't effectively pay that highest tax rate anyways. It's more the smaller caps. So I think that it matters as far as maybe under the hood, as far as with that tax policy. Regulatory policy obviously would matter as well. But that's a very low likelihood that you would get that Democrat sweep. So if you get divided government or some form of Republican, if there's a Republican sweep, then that is likely to be somewhat business as usual. We are going to have to reckon with that massive fiscal cliff. If you remember back in 2012 into 2013, that fiscal cliff, that is going to be here on steroids at the end of 2025, unless they work out whether or not the Tax Cuts and Jobs Act, those provisions really get extended. So once we do get through the election, the market will then price in the likelihood of that type of fiscal cliff event happening.
Yeah, no, I haven't heard fiscal cliff in a long time, like having flashbacks. But I think about what David Tepper said on CBC the other day. I think it was something to the effect of, as long as it's going to be a split, he doesn't have to really pay much attention to it. So that's how it looks, I guess, at this point.
So what they're saying is if there's a split Congress, like the president might be Democrat and Congress is split, so half Republican, half Democrat, the Senate, the House, and things like that. So as long as one party doesn't control the whole mix, it might be, they're saying it's business as usual, but my concern is internationally and everything else. But we'll get to that point. Okay, so then the port strike. Buttigieg, he came in, he's the Secretary of Transportation. He came in and spoke because our concern now is, this should be a huge concern for you folks, is those port strikes because they're killing our GDP, and they're going to discuss it in here, and they're adding, this is going to add to the inflation numbers. So let's get to this interview, and I'm sorry I gave you two of them, but there's a purpose for this. I want you to, you got all these distractions up here. I want you to focus in on the things that really pertain to what we're talking about today. So let's get to this interview real quick, and then we're going to go over, and I got a special thing that we just added to our website today to help you guys out there if you're looking to refinance. A fantastic tool we just added. So let's get to this, and then we'll be concluding with the economic calendar, where the MBS market is, and then I'll give you our website, how you guys can actually pick the mortgage rate you want if you're looking to refinance. So hold on one second.
And Secretary Buttigieg, it's great to have you on. Thanks for joining us. I do want to start with the port, and specifically, why is the president not stepping in on this, especially since you did take actions to step in with the rail negotiations less than 2 years ago?
Well, the administration, to be clear, has been very active here. The acting labor secretary has been engaging the parties, so has the White House, and so have I. What the president won't do is reach for the Taft-Hartley Act, because he believes that the right outcome is going to come from the collective bargaining process. That's something that has produced results again and again, not just for workers, but for our economy. I think one thing that's really important is you see the historic contracts that have been reached by the United Auto Workers, for example, and other players. We've seen historic wage increases and benefits for workers, and simultaneously historic profitability for companies. In other words, it's showing that you can do right by workers and have a lot of growth in.
Let me stop there. And I watched this interview before, but I didn't catch this. You can have all that. Yes, you can have all that. But what normally happens? Who's paying for it? And so what I'm getting at is the prices of everything went up. That's why we had inflation almost at 10%, because the administration wants everybody to make, what's minimum wage in some places, and it was in this article. Minimum wage in some areas might be $20 an hour. So now you have a worker, and it's in this data. And I don't know if I highlighted it, but one of the people said, I'm working on a multi-million-dollar machine. It's not in this article, but he's like, I'm working on a multi-million-dollar machine, and I'm basically making about the same amount as somebody working at McDonald's kiosk, filling up your bag with your hamburger and French fries and handing it to you. And no disrespect there, but then you have this machine operator that's handling this $100 million machine. And he's making the same amount as that person. He's like, this isn't fair. So you have to put all this stuff together. You just can't say, well, the record profits over here and the wages are up over here and everything's peachy. Well, how's it getting paid for? Well, that AKA comes from inflation. So let's keep going with this.
In those firms and in those industries, that's definitely something that the economics would support here. Over about a 10-year period, we've seen the ocean carriers who really control the business side, so to speak, of this negotiation. We've seen their profitability go up by about 350%. Over that same period, we've seen the wages go up by about 15%. So the workers are seeking to participate in that. We actually think the parties economically are not as far apart from each other as they may think. But at the end of the day, they're the ones who need to get to the table, work it out, reach a deal, and get those ports back open.
It's interesting to hear you say that, and I get that argument, but I also know that economists are putting out a $5 billion per day economic hit the longer the strike goes on. You're talking about inflationary activity here too the longer the strike goes on, and every economist, every freight operator, every shipper says the more costs are incurred, that is directly going to go out to consumers. So is there a point at which the administration would change stance and actually step in?
Well, look, this strike can be ended today, and what that's going to take is the parties coming to terms. The companies need to put forward an offer that's going to get the workers to the table. And again, such an offer would be absolutely compatible with the companies remaining profitable. Remember, we're talking about an industry that got unbelievable profits. There was a single year where this shipping sector took $220 billion in profits around the world. And you've got these ocean carriers, their ownership, foreign ownership, but we've been engaging them both at the global level and at the North America level. They are certainly in a position to be able to include workers to participate in this profitability. They could end this tomorrow. Now, another thing I do have concerns about is many of them have filed the paperwork to be able to introduce surcharges related to the strike. And if they were to do that, while those surcharges would, in the first instance be slapped on whoever's shipping cargo, the stores, retailers, whoever it might be, that would trickle down to the consumer. And I've sent a message saying that these ocean carriers should not be doing that, should not be taking advantage of this.
I don't think they get business. Okay, I just don't think they get business. You can't just say, well, you just got to, you guys are making way too much money, so you got to give this. So I own actually a stock, it's called Frontline, and it's a shipper. So if you go down through here, I have it because the dividend yield is crazy, but here's their net profits. I don't see, and I'm not protecting the shippers on this one, I don't see a 350% increase in their profits. I don't see it. And so I'll leave it at there. You know where my position is on that. So let's get back to it. Economic calendar right now showing basically everything just stagnant. If we go over to the bond market, where's it at right now? It doesn't like the data coming in. So we're at negative 17 right now. You can see right through here, it took a pop right at the opening bell, took a drop. It was down about 10, and then it dropped all the way down to 17. So we're down 17 right now. There's a warning sign out there. There's rates are probably going to pop a little bit. So you can probably see these rates go up to about 6.3, maybe 6.31 by the end of the day. But we will be at the closing bell to let you know how all this mess ended for the day. But now let's get over to our website. I just added a new feature to this. So if you scroll down, here's our website, therateupdate.com. So if you're out there looking maybe to buy that first house, first investment property, or refinance, visit us at therateupdate.com. My name is Dan Frio. I do this video probably twice a day, opening bell and closing bell, and I'm a mortgage loan officer. And I'm licensed in all 50 states as well as Puerto Rico, so there's no excuse for you not to use us. So if you're looking for that first house, you got to check the grant finder. Yesterday, I helped a young lady get pre-approved, and she didn't realize, but she also qualified for a $5,000 grant in our program. If you're looking to just get the ball started, you could hit the Apply Now button. Or for those out there that own a house and you're thinking, when is the best time to refinance? Well, I just added this to our website. It's right down through here. Let me get my head out of the way. They just added this, and it's right over here. So you go to therateupdate.com. You're going to go down through, and the official name of this is the Rate Watch tool. And what you're going to do is you're going to click this, and if you have a mortgage right now, you're going to put your information in here, and this is the information that we need, and you're telling us what rate you want. And as soon as that interest rate hits that number, we're going to be on the phone with you. We're going to be on the text with you. We're going to be emailing you to make sure you take advantage of your savings. So that's our new website addition. So if you need some assistance with a mortgage, just check that out. Or if you want to call us, calling is probably one of the best ways to reach us, is you can scroll down through here and you're going to get our 800 number as well as my email address. So, and that is my email address, and I will be the one responding. So thank you so much for watching today, guys. If you don't mind, please subscribing to the channel, and I will be back at the closing bell to let you guys know how the entire mess ended for the day. So thank you so much. See you then. Bye-bye.